Hey everyone, Coach Investor back to another video for today. So as promised, let's talk about Adyen. It was one of the picks for the month of September after the stock got hit extremely hard because of their earnings report, which showed slower than expected revenue growth, small hit on EBITDA as well. They talked about the increased competition in the North American market. And so because that company was already so richly valued, it got basically sliced in half. And so year to date, the stock is down 47.83%. In the last 3 months, it's actually down 57.16%. Has a forward PE of 30.5 times despite its valuation being slashed in half. Has a market cap of just under 21 billion euros. Of course, you can buy it on the Amsterdam exchange or in the US as well. Now, if we look at PE, EV to EBITDA, price to sales in the next 12 months, compared to its mean, I actually switch it to the last 5 years. It doesn't really change that much, but you can clearly see that we're now very much under its mean in the last 5 years on every metric that I put here on the screen. PE 30.5 compared to 98 times. Of course, you can clearly see that previously it was extremely richly valued. But right now, it's still an extremely good company, very, very well run. Profitability wise, it's very, very profitable. Now, I'll explain one of the reasons why EBITDA fell. It has to do with the fact that this company does not do acquisitions. Now, if you look at revenue growth estimates for fiscal year 2023, 24, and 25, by the way, they report in first half and second half. They don't report in quarterly earnings. They report in first half of the year and second half of the year. But here you can clearly see that the growth is not slow. It's over 20% when it comes to revenue. If you look at EPS, for fiscal year 2023, a slowdown, but then 24-25 back over that 20%. Now, of course, I know some of you might say, yes, even though it's down 50%, I still find it extremely expensive, and that's why I went with the likes of Block or PayPal or another company out there. I hear you, fair enough, but I do still think that this company is going to be extremely big and extremely successful in the future. I'll explain throughout the video why. By the way, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. Well on our way to reach 30,000 subscribers, so thank you very much for all the support. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So, the numbers here, you've probably seen this already before. We had processed volume for the first half that increased 23% year over year to 426 billion euros. Net revenue increased 21% to 739.1 million euros. Then EBITDA fell a little bit. It's down 10% to 320 million euros. Now, they did give us a little bit more information here. So they're meeting customer needs amid changing landscape. They say here, as a result of higher inflation and interest rates, North American digital customers shifted focus from growth to cost savings in the first half. Now, when it comes to the EBITDA hit, like I said, they're not doing any acquisitions, and they're a company that usually does the opposite than what you would expect from a company to do. Well, that's also one of their advantages. They're pretty strong and pretty profitable, so in difficult times, they can do these type of things. So in order to reach our full potential at our next phase of scale, we added 551 FTEs to the team in the first half. The majority of new hires, 75%, were in tech roles, building our global engineering muscle dedicated to both young and mature initiatives. And of course, they also build out their American sales team a bit better because that was still a bit small, and maybe that's why they can't really navigate that market right now as well as they do in different markets. Again, in the current cycle, there are lots of layoffs. Big tech companies lay off their employees, and hiring good engineers right now is much cheaper than at the peak of the hype cycle which we had in the last couple of years. Now, let's go over a couple of explanations here. So first, as a natural consequence of the shifting economic climate driven by higher inflation and interest rates, profit outweighed growth for many North American digital businesses in the first half. Enterprise businesses prioritize cost optimization while competition for digital volumes in the region provided savings over functionality. These dynamics are not new, and online volumes are easiest to transition back and forth. amid this development, we consciously continued to price for the value we bring. Now you might say, it doesn't really make sense if the likes of Braintree can undercut them, maybe steal some clients. Isn't that going to hurt the business in the long term? Well, if you want to look at churn, in the latest earnings call, they said this: we haven't seen any of our significant customers leave the platform in the first half of 2023, given that it is less than 1%, the churn that is. Of course, we've highlighted that growth was slower in North America on the digital side. They were also asked about the midterm revenue growth guidance, which was 25 to 32%. So what has basically changed since that call was made back in February? So they say here there have been shifting priorities for many of their customers. That is something that means that our growth was slower than expected. And with regards to the EBITDA, the 65% long-term EBITDA margin expectations, what's going on with that? Well, they also gave us a answer right here. If you look at how we built everything on that single platform, so how high the return is on everything we do, that means that you build on enormous operational leverage. So if we roll out the company, you get a very high EBITDA number. Currently, you see something else because we deliberately invest. We don't acquire companies, and so they have to invest in their own company, and that's why you see a short-term hit on EBITDA. Now, going back to what they said here, a recap: the time that we can say we did it is still far out. We know that growth will not always be linear, and while we saw net revenue growth decelerate in the first half, we did not see any substantial developments that structurally change our medium to long-term opportunity. In addition, we anticipate our business model's high operating leverage to kick in as we move out of this accelerated investment phase in 2024. With an ever-growing opportunity ahead, we are making the necessary investment to capitalize on it and reiterate our financial objectives. Again, this is a company that has the luxury to continue to invest more and more in their business in uncertain times. It can do what other companies cannot. Now, of course, you might say, well, in these times, why aren't they lowering prices? Well, I'm going to ask you a different question. If their churn is less than 1% right now, if the majority of the revenue is still coming from existing customers, isn't that showing that they do not really need to lower their price? They can function pretty well with the pricing that they are having right now. The fact that the other companies have to lower their prices and aren't as profitable as Adyen right now shows the strength of this company. And then when the market turns, this company will just become more and more profitable, while the others will enjoy some positive momentum as well. I do think that they are very well positioned to capture more and more profits than the others, since the others right now are really walking on thin ice. Yes, they can get some customers here and there, but how much are they making from that? Probably not a lot. At the end of the day, if you're a single platform, if you're here to invest in your business, making sure that everything is vertically integrated, at the end of the day, in the long term, this will be the best value proposition. And so looking at the graph, of course, that huge dump after the earnings report, over 50% or so, we actually broke under that magical 700 euro mark. By the way, right now we're still oversold, but maybe that weekly green candle is an indication that, well, this might have been the bottom at around 655, 660 euros. Might very well be. Right now we're at 705 euros. Maybe. Let's see what the next candle will say. But overall, for the long term, I do think that you can find a lot of value at these prices. And so to conclude, while the fintech industry is still very much hated, while interest rates are high, and while we now know that interest rates will remain higher than expected for a longer period of time, that, by the way, that doesn't mean that we won't see any rate cuts. We just know that maybe we won't go as low as expected. But if you're a long-term investor, you should be looking to buy weakness in great companies, especially when the stock gets sliced in more than half in a matter of weeks, while the company is still performing quite well. Yes, there are other options out there, other fintech companies that have been beaten down pretty heavily. Maybe you like those companies more because the valuation there is a bit cheaper, for example, Block or especially PayPal. I can understand. I just wanted to show you that there is a lot of value, and lots of excitement when it comes to Adyen as well. It's a European company. There aren't many great European companies out there, but the ones that you can find are usually one of the best out there. Of course, do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.